Good morning and welcome to this morning's Leadership Huddle webinar, COVID-19 Financial Market Uncertainty and the Impact on Seniors Housing and Skilled Nursing. I'm Chuck Harry, NIC's Chief Operating Officer, and I'll be facilitating incoming questions for this morning's panelists. Before we begin our discussion, let's review the webinar's technology logistics. You have joined the webinar using either your computer speaker system or your phone based on your audio access during your most recent GoToWebinar session. You can adjust your audio access to this morning's webinar through either your computer speakers or your telephone using the settings in the audio pane, which is located at the top of the control panel on the right side of your computer screen. We welcome your questions for our panelists during today's webinar. To submit a question, type your question into the questions panel located within the same control panel on the right-hand side of your computer screen. You may submit questions at any time during the webinar, and incoming questions will be answered towards the end of this morning's discussion. For those questions not answered during the discussion, we will strive to follow up with individual responses following the conclusion of the webinar. Now that we've addressed the webinar technology logistics, please welcome my associate, Beth Mace, who will begin our discussion.
Good morning and welcome everyone this is the first of NIC's new webinar series entitled the Leadership Huddle. We're excited that you have been able to join us, especially at this time of great duress. Let me start by saying that there may be more fog and clouds than sun and clarity in many of the comments you're going to hear today. As you know, there is great uncertainty in the world today related to the breadth and depth of the epidemiological causes and spread of the COVID-19 pandemic across the globe and within the United States. Quarantines and limited social interaction are becoming the norm. Shops and stores are being shuttered, entertainment venues closed, and those who can't conduct their jobs remotely are working from home, while many of those who cannot are being furloughed and laid off. This is underscored no more than by this morning's report from the Department of Labor that a record 3.28 million workers, applied for unemployment benefits last week as the coronavirus hit the economy. This effectively has ended a decade-long of job expansion. This weekly report is among the first economic indicators to show the effects of the virus on the economy. For perspective, this was an increase of over 3 million jobs from the prior week's number of 282,000. It has shattered all records and was the highest level of initial claims in the history of the entire time series. For perspective, at its worst during the Great Recession, there were 665,000 first-time claims filed in the week ended on March 28, 2009. And that was second only to the week ended October 2nd, 1982, where there were 695,000 first-time claims. The Great American Job Machine does appear that it's ground to a halt as a result of the pandemic. Until March, U.S. employers had added jobs for a record 113 straight months, causing the payrolls to grow by about 22 million. Last week's job losses wiped out almost a year and a half of that job gain. So on that cheery note, as partners to owners and operators of seniors housing and skilled nursing facilities across the nation, NIC is extremely concerned by the public health challenge facing most of us, and in particular older Americans. During this unprecedented global public health emergency, we offer our fullest admiration to the healthcare personnel working around the clock to ensure the safety of senior housing residents. The challenges ahead of us can only be solved if frontline healthcare workers receive the support they require to protect and serve our most vulnerable citizens, which are older Americans. This is why NIC is supporting initiatives in the seniors housing, skilled nursing, and healthcare sectors to ensure that healthcare workers get the support they need and deserve. These initiatives include governmental authorities that give staff of senior care and long-term care communities priority access to personal protective equipment such as face masks and shields. Second, for frontline workers in skilled nursing and assisted living, they need immediate no-hassle access to COVID-19 testing in order to keep them safe and stop potential spread of the virus. And third, we know about 2/3 of paid caregivers return home to care for children or an elderly family member. Employers need access to better solutions that enable these essential workers to go to work where their skills are badly needed. Collectively, for those on the call today, let's do what we can to help provide support, solutions, encouragement, and assistance for those on the front lines in our industry and for those behind the scenes in management and decision-making roles as well. Now, the name of today's NIC Leadership Huddle is, as Chuck said, COVID-19, Financial Market Uncertainty and the Impact on Seniors Housing and Skilled Nursing. By seniors housing here, I'm referring to both independent living, assisted living, and memory care. And to discuss this, I have a terrific group of experienced individuals for panel discussion. Brief bios can be found at the end of the slide deck that you have been given access to as a PDF file on the GoToWebinar page here. Afterwards, we'll send an email within 24 hours of the webinar with a link to the PDF of slides and a recording of this presentation. Today's group of esteemed panelists include Jim Costello, Senior Vice President at Real Capital Analytics, or RCA, Kurt Reed, Principal at RSF Partners, Matt Ruark, Senior Vice President and Head of Commercial and Healthcare Mortgage Production at KeyBank Real Estate Capital, and Kevin McMean, President of Real Estate at MidCap Financial Services. Before we start with the panel discussion, I just wanted to provide a bit of background of what we at NIC are hearing as initial impacts of the COVID-19 pandemic on operators. And let me emphasize here the word initial. Initially, what we've seen is from a recent survey conducted by Activated Insights, which is a senior care group of Great Place to Work. They conducted a survey among operators representing about 1,100 properties and about 100,000 units. The survey was conducted on March 18th and 19th. The survey reported that 79% of operators saw no significant changes in move-outs. That same number, 79%, saw no significant changes in occupancy. Moreover, 21% of operators surveyed actually reported an increased occupancy. Some operators have attributed this increase to how families often realize that when they are not in a position to take care of an elderly or a disabled loved one at home. Going forward, NIC has begun to conduct a survey among operators to track move-ins and move-outs, occupancy patterns, staffing solutions, and development trends. This will provide the industry timely data on what is happening at the property level and bring much needed transparency into the sector. This is what NIC is really good at, and we look forward to sharing our results with you in the coming weeks. We will provide this information to you on our nic.org website and in various other forums and emails. And for those of you who are subscribers to NICMAP, we will be having our next client webinar on April 16th, reporting on first quarter 2020 NICMAP data. At that time, we'll be able to report on the early results of this first initial survey as well. Finally, anecdotally, I've also heard from myriad operators that I've spoken to that at least in the early days of the coronavirus crisis, occupancy rates at seniors housing properties have not been largely affected. Safety protocols have been enhanced, staff contingency plans have been put in place, and accommodations to the new reality of social isolation rules have been enacted. Move-ins are still occurring, albeit often with a 14-day quarantine on a new resident, and tours are still happening, albeit virtually. That said, I don't have a crystal ball, and it's too early to say what the impact will be in coming days and weeks. So with that as background, now I want to pass the mic, so to speak, over to Jim Costello, who is going to provide us a bit of background on the capital markets and how to think of the coronavirus impact on financing activity. Jim?
Thank you, Beth. You know, when we take a look at what's happening today, you know, one of the first things to think about is just how strong was the market before we went into it. If we can jump forward to the first slide there, just take a look at deal volume through February. We just finalized these numbers for February, and you know, across property sectors, total deal activity for February was actually up a little bit from last year. Some of that was all about the industrial sector, one big entity level deal. But other sectors, you know, there was a bit of a decline, but there were still pockets of good news. You had some activity in the office market up from last year. The development site world was up. So the commercial real estate world overall, there were still some good stories going into this. Investors were still interested in the yield opportunities that are present. And if we jump ahead to the next slide, just to highlight, one story that I think is particularly important for everybody here, just the seniors housing and care sector. That sector, and we're talking from the numbers I'm looking at here, very broadly, every subtype within the sector. Deal volume was so strong relative to the hotel sector that the senior housing and care sector actually surpassed the hotel sector. Now, for February, we had 1.3 billion in activity. Technically, that was down from last year. For the first 2 months of the year, it's up. And I actually think that 1.3 in February will revise up in a little while. Some of the information does come in with a bit of a lag. But before we went into the current crisis, on a trailing basis, over the last year, deal activity was still growing for the senior housing and the care sectors. Investors were still attracted to the yield opportunity that was present. So, while we go into this crisis with a lot of unknowns, and I think one of the things we're going to talk about today is that there's still a lot we don't know. We do know that going in, it was still in a healthy state and investors were still interested. So if we can jump forward. Just for some perspective as well, though, one of the things that I think everybody here shares is that we've seen the elephant. You take a look at the photos of everybody, except for Beth. We're all older. We've been through a number of recessions, and commercial property. One thing I've started to notice when I go give talks, a lot of folks that I'm seeing are younger. That the financial crisis that we went through in 08, 09 was the only thing that they've ever seen in their careers where commercial real estate went through a recession. I took a look at price trends, taking our data, mixing it with some old survey data, some stuff from the Fed, and plotted it against recessions. What you can see is that every recession is not the same. Commercial real estate does not act the same in every recession. Part of the issue is that, you go back to the 70s, we had some recessions there where we had some changes in the supply side of the economy, sort of the ability of people to go out and spend was limited because they couldn't get gasoline for their cars, with the oil embargoes. There were other challenges at the times as well. What was so different about 08, 09 was that the financing channels froze up. That's one of the critical issues to continue to watch in this period that we're going through. If you could jump forward. The other thing that I've been hearing people talk about is, the fact that interest rates are so low. Isn't that a good thing for commercial property? I mean, through March 23rd, the average for the 10-year Treasury for the month has been 0.9%. The argument I've been hearing from some folks is that with interest rates so low, won't mortgage rates fall? Won't cap rates fall? That I'm not sure that happens. Looking here at just commercial mortgage rates at the top, the blue line, they kind of flatlined even before the drop we've seen in March. And we don't have data through March. The last data point for commercial mortgage rates was January, but it was flattening ahead of time. Lenders are hitting floors, and there are challenges that certain lenders are looking at in terms of the structure, and it's a very fast-moving thing where day to day some of the structure elements of the market are under pressure. But the low interest rate environment, at the moment, there's just people seeking safety. And yes, commercial real estate, especially ones with a good demographic story and some yield characteristics, can do well. But I wouldn't expect that we'd suddenly see lower cap rates and lower mortgage rates because of the interest rate environment we're in. I think that's people being a little too hopeful. If we jump forward, this is why I wouldn't be too hopeful. The corporate bond market has just exploded. The spread between the 10-year Treasury and the corporate bonds is a good indicator of general perceptions of investor risk tolerance. And when that goes up, they're not tolerant for risk. When that spread goes up, cap rates tend to go up. And so we've seen that spread spike into March. It's not quite as high as the spike we saw during the financial crisis. So we got that going for us so far. But that spike, it is indicative of a tremendous change in risk perceptions. And so people are going to be hesitant for some time to jump into anything, and they're going to be hesitant when they're trying to underwrite the risks around investments. So if we jump forward, the thing is, pricing, there's a lot we don't know yet. The data that we have for the pricing of assets, we have measures of price growth through February. And that market, when you price assets, people have been talking about, well, how does that compare with the pricing of publicly traded companies as represented by changes in REIT prices? So I plotted them out here, and on the x-axis, that's the NAREIT price index for every property sector, and on the y-axis, that's our measure of price growth for property types when people sell individual assets. Anything above the orange line and to the left is something where the prices of the sale of assets is doing better than the sale of companies. The thing is, these things move together sometimes, but I wouldn't think that every bump and jump in the public markets is necessarily something that comes through to the market for assets. If we jump ahead to an example for the hotel sector, this is the most extreme example. The hotel sector is currently falling in the public markets. That's the blue line. It's down tremendously, almost 30% on a year-over-year basis, but even more if we go back to the peak in 2017. The asset prices, that's shown in the orange from our commercial property price index, and it's already starting to turn down even before any COVID-related issues. It was facing pressure already from existing challenges. Deal volume was falling. There were a spate of defaults already. But here's the thing: we see those other pressures leading to those price declines in the asset market. But there are times when these things have been in sync, and there are times when they have not been in sync. You go back to 2012 to 2015, the public markets got way ahead of the asset markets for a bit and then retreated. Today, there is that underlying weakness that's probably going to lead the hotel sector even further down. And that's the thing I caution people to look at when information is scarce. There's a tendency to try and look at the public markets first and see if there's a story there, and a story about changes in the REIT shares, and we use that to infer something about asset prices. Sometimes it'll work, sometimes it won't. But I think you have to take it with a grain of salt first in looking at the fundamental health of the sector going into the downturn, and some thoughts about what it might look like afterwards. And at least going into the downturn, the senior housing and care sector was stronger. It did have some deal momentum. You had investors interested in it. So it's got that going for it. So Beth, I think that's all I've got here.
Great, that's really helpful. Thank you. That gives us a lot of context. So maybe we can go back to slide 2 now. Jim, that was particularly helpful, the last comment you made, because I've gotten a lot of questions from folks about, does the public market lead the private sector? Will private sector property valuations for seniors housing tumble because we've seen the stock prices of REITs go down? So thank you. That context was really valuable. I appreciate that. Let me go over to you, Matt. Now you're a lender. How are you thinking about this? How have lenders responded to COVID-19? Is KeyBank still lending? What are credit officers thinking about right now? Help our audience understand that a little bit, if you don't mind.
Sure. Beth, a little plug first for your Nick Insider newsletter. You're spot on. Cost of capital has changed. Terms are changing. Loan proceeds are being assessed. But, I do want to be clear. There is still financing available. But the volatility, even since, the spring Nick, has changed the landscape for sure. I think it's important to understand, the level of volatility we've seen in some of the numbers to get a sense of, the hesitancy that credit officers and lenders and others, may have, kind of leaning into, loans today, or investors may have, hesitancy leaning into acquisitions. And I know, Kurt, loves to hear the data. So, I pulled some numbers together, and I think it'll provide some context and specific context around, what Jim talked about. But I just went back and looked at, first quarter numbers, looked at the 10-year Treasury. I looked at Fannie Mae's investor spreads that we work with and get, on a daily basis from our trader. That Fannie Mae investor spread gives you an indication of, risks that, folks are pricing in for MBS or mortgage-backed securities. I also looked at, healthcare, HUD pricing. I did pick the Fannie Mae investor spread over, Freddie Mac's pricing because, Fannie Mae's spread is specific to a transaction, while, Freddie loans are pooled with others in a CME execution. So, the investor spread and the HUD pricing, kind of are middle of the fairway type deals that, that I went back and looked at. And so if you go back to, January 6th, the 10-year Treasury was, 1.81%. At the start of NIC, March 2nd, you had a 10-year Treasury of 1.10%. And we closed last night at 0.81%. You're talking about a 100 basis point move in the first quarter. That is really dramatic and not a sign of a properly functioning, market. The 10-year, during the same period also closed at, a low, all-time low of 0.54%. You look at LIBOR the same period, it's gone from 1.69% to 0.75%. In looking at, typical healthcare HUD pricing, as I said, middle of the fairway deals, we've seen, the start of the year, kind of a 3.16 rate. You go to, kind of in and around the start of NIC, that had dropped to 2.76%. And then you get to, this past week, and we were up to 3.5%. And so, speaking to some of the volatility that, Jim was talking about, we've seen investment grade corporate bonds widen, more than 175 to 200 basis points. Fannie Mae investor spreads for typical transactions have gone from 52 basis points to 200 basis points. So, 150 basis points spread, kind of widening, all in rates from the threes into the fours. So, one thing that, I did want to mention that the Fed announced, on Tuesday night that they had hired BlackRock to advise them on the commercial, agency CMBS purchases. Immediately, we saw, Fannie investor spreads come in 25 basis points and Ginnie Mae's come in 50 basis points, after that announcement. Clearly the Fed is pumping massive amounts of liquidity in the system. I heard a stat today that we have pumped in double the amount that the Fed had pumped in the Great Recession in the first 6 months, and the amount that we've pumped in already is equivalent to all of the liquidity that was pumped in during the Great, Recession. So when you combine, the COVID-19 effects, on the elderly members, of our society and all the market volatility, it's understandable why, investors and lenders, may be more cautious as they think about, acquisition prices or loan structures, for senior housing. Our credit officers, can absolutely, read the headlines. And as they think about it, is this a short-term issue where we have seen and heard from some of the owner and operators out there that, occupancy has hung in and in some cases increased, or is this going to be something that's longer term and has some dramatic impact, on top line occupancy, things of that nature? So it's definitely a concern. We've seen, a pullback, as you noted, reassessing proceeds. But, I do want to be clear, there is capital out there, but, I would say, and, probably everybody's seeing it, it is definitely, a more limited supply and not nearly as aggressive, as we saw, this time last, year or 6 months ago.
Great, thanks, Matt. So I think that's a really important message that lending is still happening, especially lending that's supported by Freddie and Fannie, and your bank is actively lending as well, although you're thinking about different things and thinking about the greater risk environment that exists today. So that's really helpful. Thank you. Kevin, how do you think about this? Can you give our audience a bit of background on your business and then tell us what's the talk in your shop?
Yeah, sure. So thanks, Beth. I appreciate the opportunity to share my perspectives. Our business, MidCap, we're a middle market lender across a variety of products, from real estate, which I manage, to corporate finance, life sciences, asset-based lending, et cetera. And so, our view right now, at least my view on the real estate sector, is that this is a time when we need to be able to support our customers and provide them with the assistance that they need to manage through very significant challenges that they may face, they may not, but they're certainly preparing for it consistently across the board in our portfolio in terms of how they're looking at the situation regarding the pandemic, and then also I think the situation with respect to the economy. So our approach has been for the last few weeks now to think about how we go about our business in that fashion, which is basically us stepping onto the sidelines in terms of looking at new business. And I think that as we look at the market, I'd be the first to say that I'm rarely the smartest guy in the room, but I have enough self-awareness, I think, to say I know what I don't know. And I think right now I don't know what's going to play out. And I think that it's very difficult to look at data, to look at historical information and say, try to draw any sort of conclusions from that and apply it to the situation that we're in, because it's completely unprecedented. So in that case, you look at new business and say, how do I assess risk around, one, the healthcare issue? If it's an acquisition, you're transitioning management, that's a challenge in any situation. Layer in all of the protective, policies and approaches that people are taking to keep, the residents and buildings safe, and keep the virus out as best they can. And in a transitional type of state with an acquisition. And I think that, there are a lot of things that, who knows what could go wrong in that situation. And then if a virus were to get into a building, we've seen some situations, certainly in the Kirkland SNF and elsewhere that we've seen in our portfolio, where that outbreak can be pretty significant and wreak havoc in terms of the life of the seniors and the residents, as well as the economic results of that building. So that's another unknown that we look at and say you can't assess what the risk of that is in this marketplace. And then you look at unprecedented unemployment filings that were reported today, and you try and look forward to see what might be the economic impact of everything that's going on to try and flatten the curve of the virus. And again, none of us have any sort of idea as to what could play out. So again, focusing on our existing customers and supporting them in what they already have, and trying to manage through that, we think is the most important thing. As we get clarity and the ability to have some sense as to what we can do in terms of projecting forward what the economy might look like, what the senior housing and skilled nursing business might look like, what the situation is with the virus. Once we have some level of clarity and can have some foresight, that's when we'll look at getting back into originating new business. But until then, our focus is on our portfolio and supporting our existing customers and sitting on the sidelines for the time being.
Great. Okay. Hey, Kurt, how do you think about investing with this level of uncertainty that Kevin just pointed out? And can you give our audience a little bit of background on your business and tell us what you guys are talking about in your shop?
Sure, Beth. So one of the benefits of having gray hair is that you look back and you realize that you've been doing this for a long time and been through many material disruptions in the country and the capital markets, and that you clearly realize that each one is very different. So over the last 30 years, I've been a real estate private equity investor. So private transactions, public transactions focused on commercial real estate and senior housing and care and other real estate related operating companies. So that also encompasses the hospitality space. And as people on the board of NIC, where I've had the pleasure to serve for the last 8 or 9 years, know that one of my favorite exercises, and we can get into this at the end, is to compare and contrast the various asset classes in real estate, among each other, and in particular, as Jim pointed out at the beginning of this webinar, the interesting contrasts that the senior housing and care space has with the hospitality space. So Beth, in these times when you're faced with an exogenous event that disrupts our business, we're an owner of over 7,000 senior housing and care units in over 40 communities. What we focus on is our existing portfolio, our relationship with our operators, making sure that we shift our focus at the highest level to communicating more frequently with all of our partners, whether it be our investors, our operating partners, and our lenders. And we focus on liquidity. In times like these, what you need to look at first is what are the liquidity needs of all of your assets and your relationships. And investors usually have plenty of sensitivity analyses in their business plans, but you need to make sure that those sensitivity analyses take into account of the data that you're getting real time. So we focus on updating our investors more frequently right now, and we focus on very frequent communications with our operators and our lenders. As Matt was teasing me earlier in the call, I'm a firm believer, and I think over 30 years watching the real estate markets grow in prestige and lower in cost of capital, that information flow, particularly during times of great uncertainty, is an enormous value to both the industry and to the investors, because whatever is going on right now will come out in the future, and those who are transparent and forthright in communicating what is going on will be viewed favorably once we get through the crisis that we're in now. And you know, the last high level thing that I would say, Beth, is, you know, in all of the charts that Jim showed, you know, there is a duration and a severity associated with them. And we have two things that we're dealing with right now. One is the direct effect of the virus. And, you know, as Kevin said, none of us know what the duration and severity of the virus is in terms of human cost, and the protective measures that we're engaged in. The other direct effect, which has a material collateral effect that Matt was trying to give you some data on, is the economic effects. And, you know, those, you know, the shutting down of hotels, you know, the impact on airlines, the impact on restaurants and retail, you know, have a direct effect on the overall economic activity. And what's really important in that is that you can measure those things, but what I worry about is what Kevin and Matt talked a little bit about, and Jim showed on his chart. I think that we really need to keep an eye on are the collateral effects of what happens in the capital markets. And so, you know, we keep a very close eye on the credit markets, and because the plumbing behind the credit markets that not all of us, you know, are involved in on a day-to-day basis are very important to allowing continued access for capital for our space. And the other thing I would point out on that is, you know, senior housing and care has if you compare it to other real estate asset classes, has a real foundation underneath it that a lot of other asset classes in real estate don't have. And that is access to Fannie Mae, Freddie Mac, and HUD lending sources, which provide a foundation on liquidity, even if it's slower and at a higher price than before, is a really important characteristic of our sector during times of uncertainty like this.
Great. I agree that it's interesting when you bring up the topic of, you know, how different or the same is seniors housing and care to some of the other property types. So when you think of assisted living, for example, we know that that's a need-based product. And so that has some legs under it in the sense too, that because it's need-based, it tends to have demand. And we saw that during the last recession. We saw that seniors housing wasn't a recession resilient sector. It wasn't completely resistant. It did have an effect. Occupancy rates did go down, but assisted living performed better than did independent living, for example, which is more choice-based. And we saw that asking rents actually did not go negative in the seniors housing sector, unlike the other property types. And then if you look at the NCREIF data, which is looking at private investor returns, seniors housing did take a hit. It was down about 6% over the course of 2 quarters, but that was not was quite small relative to the other property types. So we don't know if that's going to hold true here, but there does seem to be, between the demographics and the just the need-based component of it, that there is some legs, at least behind sort of the senior housing and assisted living in particular, those type of markets. So Matt, over to you again. So you're doing some deals, but what about the logistics of actually transacting a deal? Isn't that gotten a lot more difficult in terms of doing a property tour, or in terms of getting, you know, their appropriate paperwork put through in terms of closing deals?
Yeah, Beth, there is no doubt that the logistics of getting a transaction, you know, has gotten more difficult, and, you know, day by day there are new things that you know, are popping up. But, you know, you think about the restricted travel just of our third-party vendors, contractors, along with restricted access into the facilities. It's adding a level of complexity, to transactions that we haven't experienced before. Investors and capital sources want to be able to complete their due diligence. The restrictions are slowing down, and in some cases, stopping the process. I mean, we have seen, recording offices, closed, that's making it difficult, to, kind of record, if not impossible to, record your mortgages. And if they're not set up for e-filings, then you're just, you're at a standstill. We heard yesterday that the Pennsylvania got word that they shut down their Secretary of State office website, and then our attorneys weren't able to conduct lien or title searches. So like I said, things are popping up, daily, making it more difficult, to complete transactions. I think people are trying to get, creative with virtual tours, limited, due diligence, looking at, kind of historical trends, maybe to expenses to estimate, reserve requirements. I think just the important thing to remember is that, things will take more time, and, we need to be able to, find ways to, kind of manage some timing expectations. The due diligence is critical. It's prudent. It's the thing that we need to be doing. But I think, there are things popping up on a daily basis that, we just haven't had to deal with, and we're trying to be creative. And I give, everybody out there that's, kind of dealing with it, working with it, a lot of credit for, getting creative, and, hope that continues. But, we're going to just have to build some more time into transactions if we're going to get them closed.
Okay, and Kevin, you said that you were trying to support your customer base in this time of uncertainty and challenge. So how are you doing that?
Well, I think it's really a matter of spending time to understand what it is that they're going through, what they're anticipating their challenges may be. So I think, like Kurt said, transparency is extremely important, and we certainly always have asked that of our customers, and some are better at it than others, certainly. But understanding where it is that they're at, today, what the potential outcomes may be, depending upon different scenarios that they may model out, and you may model out with them, and then trying to figure out, well, okay, if you're in this kind of a situation and this may happen, do we need to proactively look at different covenants and work with you to reset those, or provide you with just a period of relief? Is there going to be the need for discussions around forbearance agreements or modifications to loan documents? All of that stuff is really things that we want to have proactive discussions with borrowers, and we've reached out to different borrowers, and they've reached out to us to really understand what's going on. And I will say this, that I've been very impressed with the borrowers in their ability to provide us with information to help us understand what's going on in their portfolio at the same time that they're dealing with all the challenges in their buildings, and not to say that they have a virus in their building or anything like that. It's more of just all of the day-to-day precautions that they're going through, the challenges of having to deal with. Okay, I can't have people tour, so I'm going to try and set up virtual tours. That comes with change, that comes with a certain amount of stress and anxiety about what that may hold in terms of the ability to continue to fill the buildings as people have to move out for higher levels of care, as the case may be. So it's really understanding all that and talking through things with them, and the more proactive that people are with us in evaluating what different outcomes there could be, the more that we can sit down and work with them and help them deal with any challenges that they may face. But knock on wood, as of right now, it's been very limited in terms of any impacts that we've seen in our portfolio, and hopefully it'll stay that way. But it's there will be some impacts. It's just a question of when in our mind, and then again, kind of being prepared for it and working with those borrowers.
Hey,
Great.
Beth,
Uh-huh.
we have gotten a question from an attendee with the mention by the panelists of the changing the fact that the lending landscape has changed. And frankly, it may be too early to tell at this point, but seeking some clarity on specifically how it's changed. And if any of the panelists can speak to, does this mean higher interest rates, lower loan to value ratios, higher debt service coverage ratios, or any of those metrics or sense of direction that any of the panelists could provide insight on would be helpful.
Well, I can certainly jump into that. From our standpoint, is we've looked at things going back a few weeks ago. Our view was not to look at this and say, okay, what can we do on a couple of transactions that we were working on to maybe get some additional pricing in this environment. Our focus was, how do we make sure that the capital structure is right? Can we understand the downside and make sure that we are protected in that situation? And as things unfolded day by day, our decision was that it's not something that we can get our arms around, and therefore it's not something that we should move ahead with. There certainly will be, I think, some changes in pricing because to the extent that risk is uncertain or unknown, if someone's going to do a transaction, I would anticipate that it's probably priced relatively higher today than it was a couple months ago, even 30 days ago. I think leverage from different lenders that I've spoken to is likely lower, and Matt can comment on this. But to the extent that a lender is going to move forward on a transaction, and from my take, it's banks who are looking to support first and foremost existing customers that are more active in the market than anybody else. That is, I think, the expectation. It's lower leverage, probably some relatively higher pricing. I don't know that there's any price gouging or anything like that going on. And that's, a new reality. And I think that as we move out of this, the question is, where does pricing reset? And I think that's a function of what is the outcome of the virus and the impact on buildings. How have people worked through this? How have the operators, the investors, how's their liquidity, how's their balance sheet look, and their ability to weather another issue that could pop up in the future in the context of a new term loan that's 2 or 3 years out. So it's reevaluating that financial stability of those borrowers as you emerge from this, and that could come with different pricing as well, because some may not fare as well as others coming through this process. So there's a lot of factors that will go into it, certainly, and again, a lot of that is to be determined as this unfolds over the ensuing weeks and months.
So towards that, let me ask the panel, do you think there's, what's a viewpoint on, existing financing versus financing of new development? One of the, concerns we've had prior to the COVID-19 was, the new supply that was coming into the market, especially in certain markets such as Atlanta. Development, is it going to be shut down? Is it going to be slower? We also know that construction costs are changing, labor costs are changing. Any thoughts on that? Any panelists?
You know,
Beth, it's Matt. Oh, go ahead, Kurt.
Beth, this is Kurt. In any time you have a big exogenous factor, it disrupts things on the higher risk portion of your economic activity. And, as everybody knows, you're supposed to earn a higher return for something like new development than buying a stabilized cash flowing asset. And so by definition, it's more risky. And so I would expect, material disruption in the ability of people to agree on land value, to get a construction loan, to underwrite a budget, and provide, investors with the correct, risk-adjusted return. So, I think it's pretty clear anytime we have these disruptions, development activity is one of the first casualties.
Yeah, I was going to echo that point. I mean, there's so many uncertainties. To get things to move, you have to kind of incentivize someone to take a risk. And so you're going to see a big move in terms of perceptions of prices between potential buyers, potential sellers, until things start to settle out clearer. And so, the ultimate first thing that might be hit is just deal activity. You may just see fewer investment sales. You may see fewer construction projects as all the market participants, because the uncertainty just move further apart on all their pricing expectations.
Beth,
So-
one of the things that I'll follow up on, Kurt, commented earlier is an advantage of the industry has is the backstop of Fannie and Freddie and HUD being there as a permanent lender takeout. I do from a construction perspective, if you're sitting in the lender seat and you're trying to understand what are you, as you dig into projections, in meaningful kind of projections, how do they look? It's really difficult if you don't have any history. So I would, as Kevin and Kurt have talked about, would expect that to be a tougher spot to find liquidity in, but was on the phone with Fannie Mae as we worked through an underwriting and closing of a project today. And the comment is that they are committed to providing liquidity, in this marketplace, even at the peak of volatility. But as you think about the structure, and they, kind of implemented, some additional reserve structures that can go away over a period of time. Not ideal. It's not something that borrowers would be signing up for in stable times, but we're just not in stable times. We're kind of peak volatility. And so, I think it's a really good sign for the industry that there is liquidity for those that need it. If you don't need to, execute and pay the higher price, potentially the cost of capital is up. As investors, perceive the risk to be higher, you can stay with where you are. But if there is the need, to find liquidity, to Kevin's point, is that it's out there. It's not at predatory lending rates. There's probably going to be some structure to it. You're probably not going to pull out the cash that you might have if it was 6 months ago. But we've got liquidity in the space, and I think it's unrealistic in peak volatility and still the unknown as to how long COVID-19 is going to last, is to think that it's business as usual. And so I think the good thing, and then different than in some other sectors, Kurt mentioned hotel and maybe retail, that that there may not be a lot of liquidity. We do still have liquidity in the space.
Very good. Okay, so mindful of time, we have about 5 minutes left. So I want each of the panelists, if you can, to give a sort of a summary comment to our audience about where you see us in the capital markets and in the financing markets, and if you have any good advice to provide anyone in terms of the level of uncertainty you have right now. So Jim, maybe starting with you.
Hey, Beth, could I just add on to, because we did get one question with seeking, given the uncertainty, are there any economic or market indicators that you'll be looking towards that things are settling out and we're getting back to business more in a more typical period?
Well,
the-
I'll
Go
just
ahead.
add real quick. I mean, the data that Nick is trying to collect now on a more regular basis in terms of occupancy is definitely indicators that we're going to be watching. Move in, move out rates. Obviously, the spread, hopefully not much further spread of the COVID-19 to see what's happening at the property levels. And then in terms of what's going on in terms of the economy. So we know that there was a $2 trillion stimulus package that was passed in the Senate last night. It's going over to the House tomorrow. That should take away some of the sting, not all the sting, but some of the sting. So I'll be tracking that and watching the numbers as they come out. So if anyone has an answer to what Chuck just asked, or if you have any closing comments, that would be great. And again, starting with Jim.
Yeah, I mean, the other indicator I'd be looking at is that corporate bond rate. You know, just that's a daily indicator of just how risk averse people are. And you know, as that, you know, let's hope that that starts to that curve starts to flatten as well and come back, and that people are a little bit more optimistic about the future. You know, the main thing I'd say to folks is don't panic. You know, we'll get through this. It's a temporary dislocation of demand. There's demand still out there in the economy. You know, people want to be out and about. We just have to be patient for a bit, and you know, we will get through this and be able to settle in. So it's something to just be patient and you know, don't panic.
Kurt, Kevin, Matt.
Yeah, I think Beth, to answer Chuck's question and follow up on Jim, you hit it on it, the occupancy side. I'm watching the 10-year Treasury. I'm watching investor spreads to see if things settle down and, stomachs start to calm down and we can get back to some normalcy. But I think we're going to have to work our way through the other side of COVID-19. The one thing I think about the industry, it was able to withstand the financial crisis of the Great Recession. This is a healthcare crisis that is turning into a fiscal financial crisis. If the industry weathers, and indications are now with occupancy holding or slightly increasing, that we can withstand this healthcare crisis. The industry will have shown in two different cycles the resiliency over other asset classes. I think that would then continue to attract more capital, which I think is only a positive to the industry, help values, and do kind of fulfill the Nick mission of bringing capital to the industry. So I'm hopeful and believe we'll get to the other side of this and we'll show well relative to other sectors, and look forward to getting back to the days of normal where we can talk about deal structures in a much more stable environment.
So this is Kevin. I'll jump in and let Kurt do a broader wrap up if he likes of everything as a bigger picture guy. So from our standpoint, I think it's looking at the capital markets as Jim and Matt had mentioned. That's important to understand what's going on there. It's important, for allocation of capital as well, frankly, and to understand, where it's best to put capital when we do start going back into the market, whether that's in, real estate, whether that's in corporate finance, or any of the other product areas that we cover, or industry sectors for that matter. So that's important. I think the other thing is we do ask our borrowers to provide us with weekly occupancy statistics. And so we'll be tracking that on, not a real time, but as close to real time as we can get, and see how that continues to play out. And then, to see how this, the pandemic plays out in terms of how that, the curve looks, I guess, so to speak. And then the general economic indicators, I think, are really important in this particular case, because no one knows what the response is once the people go back to work and the country opens up for business, so to speak, again. So that's kind of our focus in understanding when we can get clarity and look out in some sense of when to jump back into the market.
Great. And Kurt?
So I'd just like to remind people, everybody, whether you're in the industry or you're on the outside looking in, we in this industry are open. while other industries are being forced to shut down. We need to be there. We are there. We want to be there all day, every day to take care of our residents in our communities. And as we go deeper into this healthcare crisis, I think it'll become very clear, relative to the rest of the, of our economy, that we are open and we continue to serve our residents during the most difficult time. And that at the very high level, if you're an employee in a senior living facility, and you're getting paid, you're doing very meaningful work, and you look around and there are millions of unemployed people in America, that'll look like a pretty good position to be in. The other thing that I'd like to leave people with is, we need to continue to be transparent, and we need to increase the transparency during times of stress, not decrease it. And I know people want to hold on to information and only release good information because they're afraid that anything negative will be bad. Well, I would repeat my comment at the beginning, that information will come out. So it's better to be transparent today and provide insight into what's going on. That'll help us all in the long term. And the last thought is, real estate is a collection of leases of various length and characteristics. The leading indicator in the real estate world are the one-day leases in the hotel business. So if people are trying to figure out, what's going on in the world, we have fairly long-dated leases in the senior housing and care, particularly not contractually, but we have average lengths of stays that are many years, particularly in independent living. But if you want leading data, and I'm not saying it's predictive, but you're starving for data, the hotel industry with its one-day leases will provide you with some fascinating data of what's going on in China and the rest of the world. And I'll leave it at that.
Thank you, Kurt. And Chuck, over to you.
Yes, thank you all. As Nick remains committed to continually improving our webinars, we very much welcome your candid feedback. You're encouraged to complete the survey you'll receive following the conclusion of this webinar. Also, within the next couple days, you'll receive an email with a link to download the presentation and view a recording of today's discussion. On behalf of Nick, Beth Mace, myself, and this morning's panelists, Jim Costello, Kevin McMean, Kurt Reed, and Matt Ruark, thank you for having joined us. Please stay safe, maintain your social distance, but keep connected. This concludes today's webinar.